how to make a long-term care policy affordable, looking at the deductible. I mentioned it's called an elimination period. The most common elimination period is 90 days, and one reason most people choose the 90 days is if you have Medicare or you have private insurance, under certain scenarios, if you had, for instance, let's say you had a stroke, or let's say I had a fall. I have a fall, puts me in the hospital, and I'm there for 3 days, and I'm 65, so I'm on Medicare. That actually would begin, the Medicare policy would actually pay for a long-term care under that scenario for up to 90 days. You may have a little bit of out-of-pocket cost, but you'd have coverage for around 90 days. The long-term care policy, if it kicked in at 90 days, you would then have that coverage at that point. Another way to save money as far as long-term care, apply with a partner or spouse, apply while you're married, and while both spouses are alive and healthy. Consider it a shared care rider. Shared care rider came out several years ago, and what it says, and it's a very good benefit, because, all right, I have a policy and my wife has a policy, and my policy basically would pay a lifetime benefit of $150,000. Hers would do the same thing. But the shared care rider, if you purchase that, what it does is it ties these two pots of money together. And that's really what we're doing. We're creating a pot of money to pay for your care whenever you need that as far as long-term care. The shared care rider, let's say I went on claim, and meaning that I needed home care. Let's say I needed home care and I qualified, and I had home care and even went into a nursing home afterwards. My policy paid out to the max of $150,000, but yet I'm still alive, and yet I still need care. Under normal circumstances, I would begin paying out of pocket. With shared care, I can actually access my wife's policy and continue drawing benefit. The good thing about that is it increases my likelihood and her likelihood that one of us is going to be able to use that, because in all likelihood, one of us is going to die and may not even use our pool of money. So it just increases your chances as far as having the money available to you when you need it.
What happens to the second spouse?
The second spouse, if this is exhausted, that's a good point. If it's exhausted, we would then have to start paying out of pocket.
So you got $300,000.
Got $300,000 pool of money between the two of you. Exactly right. The average stay in a nursing home is 2.5 years. Now that's in a nursing home. That doesn't take into account long-term home care. If you threw home care into that, I already tell you the statistics are not good for that, meaning we don't know. When I first started selling long-term care and working with clients with long-term care in the mid-90s, everybody wanted a lifetime benefit, which sounds great, but few people statistically across the whole industry, few clients have ever used a lifetime benefit, used it up. Now the rule of thumb is don't choose lifetime, choose somewhere between 2 and possibly 5 years, and really look at what you can afford budget-wise. And shared care is a new rider, probably came out about 6 years ago. Back when people were choosing a lifetime benefit, they didn't have this option. So policies have kind of evolved quite a bit, and one of the newest things I'm seeing is a life insurance policy with a long-term care rider to provide benefit so that you've got some coverage for life insurance built in, long-term care built in. So that kind of is working toward how do you cover all these things that we're trying to cover at the same time. I mean, if you've got kids in college, you're planning for long-term care, you're planning for your own retirement, and you're trying to pass assets if and when you do die. Obviously, you're going to die at some point, but it's a lot to try to plan for. But those are just some of the things to consider. And again, that's considering a 3 to 5 year benefit instead of a lifetime. Compare companies with pricing. And another thing with pricing, you want to really look hard and press your advisor that's working with you to really show you some information as far as what that company has done in the past and what their rate history is, because statistics are out there now where a company's, luckily the federal government, a good thing about it, they've kind of made it so that policies have basically got to be, they've got to give you several options or background information, and also give you a rate history. If they've ever had a rate increase on an existing policy, they've got to tell you that. So you've got a lot more information. You obviously need an advisor to help guide you and help basically work down through all this information and try to figure out what kind of decision to make. What amount can you co-insure? Obviously, if you don't have long-term care insurance, you're footing 100% of the bill. Your best bet is probably to look at a combination of the two things. Figure out how much you can afford to pay if you needed care, and then how much it makes sense to actually cover by an insurance policy.